Greetings. From time to time, usually monthly, we'd like to share our insights on the macroeconomic environment, geopolitics, and how all of that is affecting the markets. So this month, let's get started first with a quick look at the equity market. Well, markets have really been on a roller coaster in 2018 and 2019. In the first 3 quarters of 18, things were very strong, and then the Fed offered some comments about overshooting, and the market rolled over in the fourth quarter. They got their messaging a little bit better in the fourth quarter, and in the first 4 months of 2019, the equity market rebounded, only to face escalating trade tensions in May, which caused, again, the market to roll over. At the end of May, the tensions backed off a little bit, markets moved higher into June and into July, but then those tensions reappeared on July 26th, and since then, the markets have been choppy. Truly a roller coaster. Now, when we do this work, we tend to think of things from a macro perspective, a markets perspective, and then look for themes that are developing, as well as trying to identify headwinds and tailwinds. So a little bit of a look under the hood, a few takeaways. First, central bank support. We're seeing it all over the world, and that particularly includes our own Federal Reserve. Second, volatility, mostly event-driven, driven by things like geopolitics. Examples, U.S.-China trade, and Brexit. Now, an anchor for our 2019 outlook when we look back to the beginning of the year was resolution. We anticipated some kind of Brexit deal. We anticipated some kind of U.S.-China trade agreement. We anticipated the Fed to be thoughtful, not overshooting, and in fact being data dependent, and they have been. We anticipated some kind of federal government bipartisanship. That's not really happened. There's been some legislation submitted, but things are obviously moving very slowly, a bit of DC gridlock. But overall, we expected animal spirits to improve, and they really have in 2019. Now, if we dive a little more deeply into 2 of these topics, U.S.-China trade. Well, we have a phase 1 deal. What's that mean? Suspension of more tariffs, China agreeing to purchase more agricultural goods, China offering more transparency and more openness to their markets. Now, phase 2 will likely focus on things like intellectual property or IP. Now to Brexit. Well, Boris Johnson and the EU have a new agreement, but still Parliament has to approve it. And one issue that remains for them is how to treat Northern Ireland. Now at Stifel, we actually monitor all of this as part of what we call the geopolitical dashboard. So risks that we see that we have to monitor. Things like North Korea, Gulf tensions like Iran, the possibility of cyber attacks or terrorism. We actually separate U.S.-China trade from U.S.-China competition. We think if a trade deal gets done, that's great, but competition will be here to stay. And then we list various elections, but of course, one that we should really consider carefully is the U.S. presidential election. As we thought about this, we realized it probably makes sense to think of this election in 4 phases. We're in what we call the early primary. What's that mean? It means there are many, many different candidates offering many views on many topics. It's pretty confusing and difficult to look at all of those and try to anticipate the impact on the economy and the markets. Eventually, we'll get to a late primary stage. There we'll see 1, 2, maybe 3 candidates really emerge, which allows us to focus. We'll be able to dig in on their policies and try to understand the policy impact on the economy and markets. Now, through all of this, during the primary, of course, the impeachment inquiry will be front and center. We see likely a House impeachment, and then we see likely a Senate acquittal. So that'll bring us to the election. The Democratic candidates identified up against the president, and we'll be able to gauge from polls and other measures who the likely winner will be, and again, assess their policies for the economy and markets. Then, of course, the election will have occurred, we'll know who the president-elect is, and we can dig into those policies and adjust further. Now, with all that as a backdrop, let's consider more broadly the macro environment. Let's start with assessing the risk of recession. We track 4 categories to monitor a recession. First, financial readings. Second, inflation. Third, the consumer. And 4th, business. Now, by these measures, we see 3 points of weakness. A flat yield curve, meaning that the short end is similar to the long end of the curve. Strong wage growth, which on the surface sounds good, but it actually can lead to inflation, which is problematic. And then third, soft data when it comes to truck shipments. But what's that mean? Well, 10 out of the 13 readings that we track are actually signaling continued expansion. Now let's zoom in on the consumer. We monitor 9 readings, things like retail sales, income growth, unemployment, and confidence. Take retail sales. It's a very volatile series. We look at a rolling 3-month number. In the last 3 months, the average was a year-over-year 4.1% growth rate, a very strong number. Consider consumer confidence at 125.1. This is historically very high. So the consumer overall is with us, and it's really supporting this economy. Now let's look at housing. We monitor 7 different readings, things like home builders, mortgage applications, housing starts, and various sales metrics. Now we've seen a little weakness from time to time in housing, but lately all of these readings have been positive. Let's turn to business. Well, we monitor about a dozen readings on business, things like forward-looking purchasing managers' indices or PMIs, inventories, and CapEx. Now, while slowing, generally things are positive both on the services side and overall. Yet we've seen some modest weakness in manufacturing. So a few weeks ago, we dug into this a little bit, and here's what we learned. When we look at manufacturing, when we go back to World War II, it basically represented about 28% of overall GDP. That number today, 12%. Now, jobs have followed suit. Back near World War II, 1 out of every 3 jobs was in manufacturing. Now, only 1 out of 12. So the conclusion, weakening manufacturing doesn't necessarily mean a recession. Now let's take a look at inflation. Our monitoring of inflation includes 7 different measures, and most readings are below the Fed's 2% target. So why is this important? Well, low inflation means that the Fed can cut rates if it needs to without risking inflation getting out of control. That's a good thing. Now, the Fed overall is monitoring lots and lots of things, but here are 4 key measures we think they're watching. First, again, is inflation, which is below their target. Second, employment, which is very strong. Third, financial conditions, which have been balanced. And fourth, GDP growth itself, which remains positive. So the conclusion, the Fed doesn't see recession coming and has room to act to continue to be supportive as needed. Let's go a little deeper into employment. By numerous measures, we show employment to be very strong by historical precedents. The unemployment rate, new jobs, wage growth, and low jobless claims. Interestingly, the Fed is working more closely with ADP on payroll data, monitoring hiring for signs of a slowdown. By their backtesting or studying of history, this is shown to be very helpful. But again, employment remains very strong. Now, when we wrap all this up, sometimes we look at indicators that are considered leading, meaning that they're going to point us to the future, and there are indices that are called leading indicator indices. When we look at those, these are showing a slowdown. But it's important to note, when we look at history, this sometimes leads to an actual slowdown and sometimes not. So let's turn to the markets. When we think of the markets, we're anchored on the economy and how it's doing, and both the economy and the markets are cyclical. They sort of happen to unfold over the long term. So let's start with the economy. Well, we're 124 months into the current expansion. The current expansion has been lower for longer. When we look back over the last 70 years, we see strong cumulative economic growth over long periods interrupted by short, less dramatic recessions. And as mentioned, we think this expansion will continue probably for at least the next 12 to 18 months. Now, let's turn to stocks. Well, along with this economic expansion, we've been in a bull equity market for well over 10 years. And the cumulative growth of this market expansion, 340%. So, like economic cycles, stocks are subject to longer-term cycles too. There are extended periods of cumulative growth followed by shorter, less dramatic, what are called bear markets. So are we at a market top? Well, we track 9 measures to look for a market top. Things like heavy buying of stocks, a big pickup in mergers and acquisitions and initial public offerings or IPOs, and things like growing pessimism about earnings or the widening cost of credit, meaning borrowing. At present, none of these measures are strongly signaling a market top. But what about market levels in general? Well, whether you're investing for the short or the long term, it's always helpful to monitor various capital markets. Let's start with rates. We've seen the Fed cut its target interest rate twice this year. Treasury rates have fallen since the fourth quarter of 2018 and have flattened recently, again meaning that shorter rates are similar to longer rates. Sometimes this is a sign that the Fed will act further. Now, I mentioned we track the cost of credit, and those measures remain in a reasonable range this year. So what about the Fed? Well, formally speaking, the Fed's own outlook is they won't need to cut rates over the next year. But the market's view, people are anticipating 3 to 4 more cuts over that period. Now, how often is the market right? In practice, market participants don't do a great job anticipating Fed action. Now let's move on to U.S. equities. In general, a company's stock price relates to its earnings, as measured by the price-to-earnings ratio. So when we look at the S&P 500 as a proxy for U.S. stocks, we see this market fairly valued by some measures and perhaps modestly overvalued by others. But a key focus, earnings growth next year and beyond. When we look at the forecasted earnings for the balance of the year, we see earnings stabilizing. Then when we look into 2020, the consensus forecast is for earnings growth to be over 10%, which is supportive of stocks from here. Well, what about non-U.S. stocks? Well, non-U.S. stocks have performed well this year, but not as strong as U.S. stocks. From a valuation perspective, non-U.S. stocks appear much more attractive. But our keen focus remains on the economies in these other regions of the world and the corresponding earnings outlook. So how do we put all this together? Our general guidance continues to be anchored on diversification, guiding our clients to invest in various asset classes, including non-U.S. equity exposure. Our strategic allocations include large and small cap stocks, as well as investment grade and high yield bonds. Some of our key leanings for the short term: we're overweight large value in U.S. equity, we're overweight Europe outside the U.S. in equities, and we're overweight corporates in the taxable bond market. So, when we do all this work, certain themes seem to come together. Our current focus includes continually assessing this late cycle, both the economy and the markets, inflation, future Fed policy, and interest rates, shifting demographics like the importance of millennials on future economic growth, and geopolitics like U.S.-China trade and then future U.S.-China relations. As we monitor the geopolitics, the economy, and the markets, we'll seek to keep you updated as our work unfolds. We appreciate you taking the time today to listen to our session. We at Stifel welcome further engagement as you consider how this work might influence your own investment decisions. Thank you.